Alan asks, I have invested my superannuation with Christian Super in the highest risk category since before the global financial crisis. Naturally, I've lost greatly, so am I best to leave it where it is and ride out the storm, or is there something better that I can do? Yeah, and then this is a question and a theme that has come through consistently across the board. And as I think it was Michael who was a missionary returned from overseas, it's a difficult situation, and I feel for people in the scenario where they're looking at retiring. But Alan, I'm not sure how far you are from retirement, but if you are able to ride out the storm, you would, and you've got 10 years to invest, then maintaining the ethical shares is potentially the best option, because if you go back to that chart where how long it took to get back to previous highs again, it's likely that in that period of time, you will return more than your money if you're continuing to work, and you're able to continue to put money into the market during these negative or low points. Then it can have a good long-term return. But the challenge is for those people that are retiring, and if you are retiring and need some to provide for your income in retirement, then potentially you should be moving back to a more conservative portfolio, and unfortunately have to lock in some of the losses, have to move back to a more conservative portfolio, or have a portion of it sitting in cash. But it is a really difficult scenario if you are in that tricky phase of either approaching retirement or retired. It is quite a difficult decision to make to lock in those losses, and it's not a straightforward one. What I do encourage people to do is if they're in the highest risk option and they know that over the next few years they're going to start drawing on their superannuation, then it's really a good structure to continue to move it into a lower risk option slowly over time, like I talked about earlier. And then it's managing the risk. There's a whole concept of dollar cost averaging, where you slowly put money into the market. You effectively dollar cost average by your employer contributions going into your superannuation account each pay period. You're effectively buying less units when the prices are high, and you're buying more units when the prices are low. The same thing can be done when you're moving down out of an option. So moving out of a high risk option to a low risk option. If you do that slowly over time, it reduces the risk. It reduces the impact of doing that in a large lump sum. Having said that, if the market shot up to 5,000 or 6,000 points quickly, then I think that would be a reasonable time to potentially do move larger amounts across to more conservative investment options. But the important thing is trying to put a strategy in place, thinking that strategy through, and not letting your emotions drive the decision making. Have a strategy, be comfortable with that strategy, whatever that might be, whether it's dollar cost averaging out, or whether it's saying that when it hits a certain level I'm going to move some money out. Don't let your emotions guide you, because if you do that, you inevitably sell out at low points and then only get back into the market when it's returned, when the market's gone up, and so you've missed out on that return.